We will be presenting on Chapter 4, Tax Planning and Strategies. This is our team, and these are the topics that we will be going over. So, what is the federal income tax structure? We are under a progressive or graduate rate tax, a tax system where tax rates increase for higher income. So, those who earn more can afford to pay a higher percentage of their income in taxes. People who earn different incomes fall into different tax brackets. Tax brackets are income ranges in which the same marginal tax rates apply. For example, an individual might fall into the 15 or 28% marginal tax bracket. Now, not all income is taxable income, as some income is tax-free due to deductions. Taxable income is determined by two functions, AGI and deductions. Deductions are any expenses that reduce taxable income. Itemized deductions are deductions calculated using Schedule A, which is a Form 1040 by the IRS. Standard deductions is a set of deductions allowed by the IRS, regardless of what taxpayers' expenses were. Now, your taxable income is income subject to taxes, and your AGI or adjusted gross income is your taxable income from all sources minus specific adjustments. And this all comes before deducting your standard or itemized deductions. Now, when filing a tax return, there are four different filing statuses: single, married filing jointly surviving spouses, married filing separately, and head of households. And all these comes with different perks and benefits depending on what your filing status is. Now, in the year 2025, this is just a demonstration of the tax brackets and federal income tax rates depending on what your filing status is. And you fall under different tax rates based on your tax filing. Scenario one. So let's say you're married with a combined income of 70,000 and are filing a joint return. You made a 2,000 deductible IRA contribution and paid 900 interest on a student loan. Let's calculate your AGI. So your combined income of 70,000 minus 2,900 of tax deductions gives you an AGI of 67,100. And now remember, your AGI minus your tax deduction is taxed. Scenario two, since you are filing a joint return, your standard deduction for year 2025 is 31,500. Now, let's calculate your taxable income. So there's 67,100 of your AGI minus 31,500 of your deductions gives you taxable income of 35,600. We can determine that in this scenario, we are in the 12% tax bracket. Now remember, taxes are graduated, meaning that income is taxed at an increasing rate. So the last dollar you earn is taxed at 12%. So the first 23,850 is taxed at the 10% rate. And then the next 11,750 is then taxed at 12%. This makes your total tax bill $3,795 that you owe in taxes. Now, in a third scenario, let's say you report your tax return to have three children under 17 years old. Your tax credit per child is $2,200. This gives you a child tax credit of $6,600. Since this also exceeds your total tax bill of $3,795, you may receive a refund of up to $5,100, $1,700 per child. Now, let's go over the marginal tax rate. This is the percentage of the last dollar you earn that goes towards taxes. For example, let's say your taxable income is $60,000 as a single filer, you fall under 22% tax bracket. This makes your marginal tax rate 22%. And then let's say you make $1,500 through a part-time job. This extra $1,500 is then taxed at 22% since that is your marginal tax rate. Now, let's go over tax deferred. This is income on which the payment of taxes is postponed until a future date. So let's say you consider it in a tax deferred retirement plan. Since your marginal tax bracket is 22% and you contribute $1,000 to that retirement plan, you are actually lowering your taxes by $220. Now let's go over capital assets. This is an asset you own except for certain business assets like stock, bonds, and real estate. Now you can get a capital gain or capital loss, which is the amount by which selling price of your capital asset differs from its purchasing price. And let's go over capital gains tax. This is the tax you pay on your realized capital gains. So let's say you buy 100 shares of Apple for $258 per share, and you sold them 5 years later for $158 per share. You now get a capital gains tax of $20,000. Now, in the same scenario, let's say you then sold it, but for $158.28 per share. You're now at a capital loss of $10,000. Now, going back to scenario one, you have to now pay capital gains tax on that $20,000.
Hi, everyone. I'm going to be going over the other taxes section of Chapter 4, starting with payroll taxes. First being Social Security. Social Security is a mandatory federal insurance program, and it provides benefits tied to retirement, disability, and survivors benefits. It's funded through payroll taxes, which for most employees, the Social Security portion is 6.2% paid by the employee, and then another 6.2 paid by the employer. It only applies up to a wage cap called the annual wage base. So in 2026, the Social Security wage base is 180,000. That means if you earn up to 180,000, you'll pay 6.2% on that. And then once you pass that threshold, you stop paying Social Security tax on any additional wages for the year. So in 2026, the maximum employee Social Security tax that someone can pay is 6.2% of 180,000, which comes out to 11,160. Um, then there's Medicare. Medicare is the federal government's health insurance program. It's primarily for people 65 and older. It's also funded through payroll taxes, but unlike Social Security, there's no wage cap. The base Medicare payroll tax, it's 1.45% for the employee, and then also 1.45% for the employer on all wages. For higher earners, there's also the additional Medicare tax, which adds 0.9% once wages pass certain thresholds, and that's 200,000 for single filers and $250,000 for married filing jointly. And then there's also the self-employed treatment. If you're self-employed, you generally pay both sides of the employee and employer sides. So 12.4% for Social Security and 2.9% for Medicare. Although half of that is deductible when you're calculating your income tax. Moving on, there is state and local income taxes. So some states and even some cities tax income, and the reading ties this to the SALT deduction, which stands for state and local taxes. SALT matters because taxpayers may be able to deduct certain states and local taxes on their federal return, like property taxes and either income or sales taxes. But there was a major change highlighted in the reading, which is the cap introduced in 2018. The cap was updated by 2025 tax legislation and continues through the late 2020s. If you live in a high tax state, the federal tax benefit of deducting those taxes can be limited, which affects after tax costs comparisons across states. Then there's non-income taxes, starting with excise taxes, which are charged on specific goods like alcohol, tobacco, gasoline, and air travel. Then there's sales taxes, which are they're applied broadly to purchases and are often considered pretty regressive because lower income households tend to spend a higher portion of income on taxable consumption. And then there are property taxes, which are just based on the assessed value of a real estate property or any other property. Lastly, there's gift and estate taxes. These apply when wealth is transferred either at life or death. There is the exclusion amount, which is indexed and can change with legislation, but in 2026, it's 15 million per person or 30 million for a married couple. Any amounts above that may be taxed potentially at around 40%. So that's definitely something to keep in mind for, most households it won't apply, but for high net worth families, it can definitely impact wealth transfer planning in the future. That's all from my section. Thank you for listening. I'll pass it on.
In this section, I'll explain how federal income taxes are calculated. The process follows a structured sequence, which begins by determining your gross income, subtracting adjustments to calculate your AGI, subtracting deductions to determine your taxable income, and applying tax rates to calculate your base tax. And finally, subtracting credits to determine your total taxes due. So first, to determine your adjusted gross income, you have to figure out what your gross income is. And your gross income is the sum of all taxable incomes from all sources. The IRS categorizes income into three types, which is active income, which is your wages, salaries, and business incomes, portfolio income, which is your stock portfolio, dividends and interest, and passive income, which is rental income and royalties. In addition, gross income may include capital gains, IRA distributions, pensions, unemployment compensation, and taxable Social Security benefits, but not all income is taxable. Tax-exempt incomes include interest on state and local bonds, gifts, inheritances, child support payments, certain welfare benefits, and some foreign income. Key point, gross income only includes taxable sources. So once you have your gross income, you can calculate your AGI, or your adjusted gross income. And AGI is your gross income minus allowed adjustments. And adjustments reduce income before deductions are applied. Common adjustments include contributions to qualified retirement accounts, such as IRAs, 401k plans, student loan interest, self-saving account contributions, and for those who are self-employed, half of self-employment taxes. These adjustments are sometimes referred to as above the line deductions because, once again, they are subtracted before calculating your taxable income. AGI is very important though, because your deductions and credits are based on your AGI levels a lot of the time. Your next step is to subtract deductions. So taxpayers must choose between the standard deduction and itemized deduction options. You should take whichever one is larger because it's being subtracted from your AGI. So itemized deductions include medical expenses that are over 7.5% of your AGI, state and local taxes, mortgage interest, charitable contributions to qualified organizations, and certain causality or theft losses. So the standard deduction is a fixed amount determined by filing status as well, and it's adjusted periodically for inflation, meaning that if you're married, you'll get some tax benefits, for example. It's also critical to understand that deductions reduce taxable income or taxes directly. The tax savings from a deduction depend on the taxpayer's marginal tax rate. So once you have your deductions, you can subtract your deductions from your AGI and get your taxable income. Taxable income is used with federal tax tables or rate schedules to determine your base income tax. And the US system is progressive, meaning income is taxed at brackets at increasingly marginal rates. So the more money you make, you should be taxed, the more you should be taxed. Filing status determines which tax brackets apply. So if taxable income exceeds certain thresholds, taxpayers may also be subject to the alternative minimum tax, or AMT, which applies different rules to ensure that ultra high income individuals pay at least the minimum level of tax. Your next step is subtracting credits. And unlike deductions, which reduce taxable incomes, credits reduce tax liability dollar for dollar. Some credits include the child tax credit, education credits, earned income credit, health insurance premium credits, and adoption credits. These credits are refundable, meaning they can generate a refund even if the taxpayer has no remaining tax liability. And total income tax due equals your base income tax minus your applicable credits. So tax calculation follows a very defined structure, starting with identifying your taxable income, adjusting it, subtracting your deductions, which will result in your taxable income, applying your tax rates, and reducing the results through credit, and will result in your final taxes.
What's up, class? My name's Alex Bauman, and I'm going to be presenting on Learning Objective 4, which is Other Filing Considerations. So far, we've looked at tax rates, deductions, and credits to determine the final tax amount. But once that number is calculated, the process isn't over. Taxpayers still have to file their return with the IRS. That means using the right forms, submitting the return, meeting deadlines, and knowing what to do if mistakes happen. This part of the chapter is about how taxes move from calculations to real-world filing. Form 1040 and schedules. The main form individuals use to file their federal taxes is Form 1040. Taxpayers age 65 or older can use Form 1040 SR, which is simply a larger print version, but the tax rules are the exact same. Many people also attach schedules to their forms. Schedules are extra forms that report specific types of income, deductions, or credits. For example, Schedule A is used for itemized deductions, Schedule C is used for business or self-employment income, and Schedule D reports capital gains from investments. These schedules give more detail and support the numbers on the main return. Submitting the return. Once everything is completed, the return has to be submitted. Taxpayers can still file by mail, but nowadays most people e-file. Electronic filing speeds up refunds, reduces math errors, and gives confirmation that the IRS received the return. If someone can't meet the filing deadline, they can request an extension using Form 4868. This gives 6 additional months to file the paperwork. However, an extension does not mean that they don't have to still pay on time. Any taxes owed are still due by the original deadline, and unpaid balances may lead to interest and penalties. Fixing mistakes. Mistakes happen, taxes are tough and challenging. A taxpayer might forget to report income or realize later that they had missed a deduction. The IRS allows people to correct errors by filing an amended return using Form 1040-X. In most cases, taxpayers have about 3 years from the original due date to fix mistakes. This gives people a chance to correct honest errors and make sure their tax return is accurate and up to date. IRS audits. Sometimes the IRS reviews a return more closely. This is essentially what an audit is. Audits are relatively rare, but they're more likely if a return shows very high income, unusually large deductions, or business losses. The best protection is good record keeping. Taxpayers should keep receipts, statements, and documentation that support their numbers for when the IRS comes knocking at their door, they're able to fight it. And don't worry, getting audited doesn't automatically mean someone did something wrong. It just means the IRS picked them as the lucky winner of some extra paperwork. Taxpayer assistance. So what if a taxpayer isn't sure how to handle all of this? There are many resources available to help the process of submitting tax returns and filing your taxes. The IRS provides publications and online tools, and many people use tax software or hire professionals like CPAs. One important thing to remember is that the IRS does not contact taxpayers by email, so scam awareness is important. Now that we've seen how the filing process works, let's look at how all this comes together in a model taxpayer example.
Hi, my name is Richard, and I'll be going over the model taxpayer and the tailors file their federal tax return. When filing your tax return, it's important to understand what are taxable events and how certain tax events are categorized. One example of this is Keyshawn Taylor receives a gift from his parents of $10,000. This would not be included on your tax return because it is below the $19,000 annual exclusion limit for gifts. Example 2. Priya Taylor goes onto a game show and wins a brand new car. She later realized she had to pay taxes for it. She then went to get it appraised and they found it to be worth $20,500. So it will be under her taxable income as other income. Example 3, Keyshawn Taylor contributed $6,000 to his traditional IRA, $1,000 under the yearly contribution limit for individuals under the age of 50. This is a tax event and would be a benefit because it ends up being subtracted from your total income as seen on line 10C and 11 of the first page of your 1040. That all being said, let's see what a 1040 looks like and how these events would apply. Page 1 of your 1040 in 2025 would look like this. It would have general information with regard to your identity, name, social security, and address, as well as dependents information and their legibility for tax credits. It would also, in the next section, have your income. This section would cover all sources of income as well as the type of income. As you can see in the document, line 1A shows your total amount earned from work. In this example, both of the Taylor's employers would have provided their W-2 income and they would have added them together. Line 8 shows the income in the form of the car she won. Line 9 shows the summation of, in this case, the Taylor family's income from work, as seen in 1A, $78,000, interest income, line 2B, $760, and short-term capital gains on stock, line 7A, $750, and winning the car, line 8, $20,000, which sums up to $100,000, $165. You then subtract their IRA contributions, $6,000, as these are tax deductible and you have their adjusted gross income of $94,165. On the second page of your 1040, you would see tax and credits. The Taylors in this section would start with their AGI and then decided to do a standard deduction, as seen in line 12E, of $24,800. This data came from 2020 to preface this. For 2025, they would have deducted $31,500. Taxable income is derived by subtracting your AGI by the sum of your deductions. Line 14, in this case, 15 is the sum, being $69,365. You then calculate your tax by using the tax tables. In this example, it would equate to $7,930 on line 18. After they subtracted their tax credit for having dependents, line 19, $4,000, from their tax, they would receive their total tax of $3,930, as seen on line 21. Payments and refundable credits. This section shows that the Taylors had federal income tax withheld from the previous year of $4,150, as seen on line 25A. And finally, the last section, the refund. The Taylors then subtracted their total tax by the previous year tax withheld in line 34, and they would get $220, showing the amount they overpaid, and right under you list how much you want refunded to you in line 35A.
Hi everyone, my name is Vinny Madon, and I will be talking about my section which covers up learning objective 6 from chapter 4, which focuses on tax strategies individuals can use to legally minimize their taxes. So the most important distinction between tax avoidance and tax evasion is tax avoidance means using legal strategies built into the tax code to reduce taxes owed, while tax evasion is illegal and involves hiding income and falsifying information. One common strategy is income shifting, where incomes or assets are moved to someone in a lower tax bracket when permitted. Another major strategy is tax deferred income, which involves retirement accounts such as 401ks, IRAs, which lower taxable income today and delays taxes until the money is completely withdrawn. And with tax-free income, some income can be tax-free, such as interest from municipal bonds, which is not subject to any type of federal tax. Finally, taxpayers can minimize taxes through deductions and credits, as well as timing income and expenses by accelerating deductions or delaying income to reduce the total taxes owed. Here I have an example that is tax deduction versus tax credit. And in this example, to see why some tax strategies are more effective than others, it's helpful to compare. So in this example, we have a taxpayer earns $60,000. We're assuming that a taxpayer earns $60,000 and it's in the 22% marginal tax bracket. If the taxpayer claims a $1,000 tax deduction, that deduction reduces taxable income by $1,000. At a 22% tax rate, the actual tax savings is only $220. Now let's compare this to a $1,000 tax credit. A tax credit reduces the taxes owed directly, dollar for dollar, meaning the taxpayer saves the full $1,000. This shows why tax credits are generally more valuable than deductions. Next up, the example we have is a tax-deferred income retirement example. And in this example, assume an individual earns $70,000 a year and contributes to $5,000 to a 401k. If their tax is 22%, that contribution reduces taxable income from $70,000 to $65,000. The immediate tax savings is $5,000 multiplied by 22%, which equals $1,100 that were saved in the current year. And although taxes will be paid later in retirement, tax deferral lowers taxes today and allows investments to be able to grow over time. Why does tax planning matter? It reduces total taxes paid over time, helps individuals keep more of their income, encourages long-term financial planning, and uses legal strategies within the tax code. Overall, in our entire presentation, and Learning Objective 6, it shows how effective tax planning is about understanding how the tax system works and using legal strategies to minimize taxes. These tax strategies highlight why planning ahead is essential for building and protecting wealth. Thank you.